Losing a loved one is one of life's most profound challenges. In the midst of grief, the last thing anyone wants to think about is paperwork, let alone the complexities of taxes. Yet, managing the financial legacy left behind is an unavoidable part of the process. For many families, this brings up immediate questions about what the government might take from the assets their loved ones worked so hard to build. Two terms often surface during this difficult time: estate tax and inheritance tax. While they are frequently confused or used interchangeably, they apply to very different parts of the wealth transfer process. In this guide, we will break down the differences clearly, helping you navigate your financial responsibilities while honoring the legacy of those who have passed. Losing a loved one is undeniably one of life's most profound challenges. In the immediate aftermath, the focus is rightfully on family, on grieving, and on honoring a legacy built over a lifetime. The emotional weight can feel overwhelming, and coming together to share memories is an essential part of the healing process. But as the initial wave of grief begins to settle, a different kind of reality inevitably sets in. Alongside the emotional aftermath comes the practical and often overlooked financial complexities. Stacks of paperwork, legal notices, and the daunting reality of settling an estate demand attention, pulling you into a world of complex rules and regulations. Suddenly, families find themselves navigating not just the loss of their loved one, but questions surrounding assets, wealth transfer, and, of course, taxes. Understanding the financial obligations left behind is a crucial step in preserving the legacy you hold so dear. Let's start untangling this web. To grasp how wealth transfer is taxed, let's start with the estate tax. Unlike taxes paid by the person receiving an inheritance, the estate tax is levied on the total net value of a deceased person's assets before anything is distributed to their beneficiaries. Think of it as a final, comprehensive accounting of absolutely everything you own at the time of your passing. So what exactly constitutes an estate? It includes all of a person's physical and intellectual property, financial accounts, real estate investments, business interests, and even personal belongings. Crucially, if an estate tax is owed, it is paid directly out of the estate's funds by the executor. This means the heirs simply receive what remains after the final tax bill is settled with the government. But here is the good news. The vast majority of families will never encounter the federal estate tax. This is due to the extremely high federal exemption limits. For instance, for the tax year 2024, the federal exemption sits at $13.61 million per individual. Only the portion of an estate's value that strictly exceeds this massive threshold is actually subject to the federal estate tax. Let us flip the coin and look at the inheritance tax. Unlike the estate tax, which is paid before the money leaves the deceased person's accounts, the inheritance tax is a state tax levied directly on the recipient. Think of it as a toll you pay when the assets arrive in your hands. This distinction is crucial. With an estate tax, the estate itself bears the financial burden. But with an inheritance tax, the burden falls entirely on you, the heir. If you inherit $50,000, you are personally responsible for reporting and paying the tax out of that inherited amount. There is no federal inheritance tax, and only a handful of states currently impose one. In those states, your relationship to the deceased dictates your rate. Spouses are almost always exempt, and children get much lower rates than distant relatives. Because state laws vary widely, navigating these rules requires filing specific tax forms with the state revenue department. Consulting with a financial professional is essential to ensure you file correctly and are not caught off guard by a surprise tax bill on your newly acquired assets. What fundamentally sets these two taxes apart? The biggest difference is who writes the check. With an estate tax, the tax is calculated on the total value of the deceased person's assets and is paid directly by the estate before any money is distributed. An inheritance tax, however, is paid by the people receiving the assets. Once the estate is divided, the beneficiaries are responsible for paying taxes on what they inherit. The rate they pay usually depends on their relationship to the deceased. A major misconception is that inheriting money means an automatic federal tax bill. In reality, the federal government does not have an inheritance tax. They only levy an estate tax, which only applies to extremely wealthy estates worth well over $10 million. Another myth is that all states tax inheritances. The truth is, only a handful of states collect an inheritance tax. Understanding these clear differences helps eliminate confusion when planning for your family's financial future. Now, you might be wondering, will my family have to pay these taxes? The good news is that the vast majority of Americans will not. When it comes to the federal estate tax, the exemption threshold is incredibly high. For 2024, an individual can leave behind over $13 million without owing federal estate taxes. Because of these limits, only a tiny fraction of the wealthiest estates are actually affected. But even if you are safe from the federal tax, your state might have its own rules. 12 states, plus the District of Columbia, impose their own estate taxes. And importantly, these state-level exemptions are often much lower. For example, in states like Massachusetts and Oregon, the threshold is just $1 million. Inheritance taxes are even more localized. Only 6 states collect an inheritance tax: Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. However, close relatives like spouses and children are often completely exempt. Ultimately, whether these taxes affect your family depends heavily on exactly where you live and who is inheriting the money. Navigating the complexities of inheritance and estate taxes can often feel overwhelming, but the true key to financial peace of mind is proactive planning. Waiting until the last minute can lead to significant and unexpected tax burdens for your loved ones. This is why taking decisive action now is crucial for your family's future. Your most effective first step is to consult with qualified legal and financial professionals. An experienced estate planning attorney or financial advisor can help you navigate specific state tax laws. They will carefully assess your unique financial situation and accurately estimate any potential tax liabilities your estate might face. These professionals can guide you in exploring a variety of powerful planning tools to minimize these taxes. Establishing legally binding wills, setting up strategic trusts, and utilizing structured annual gifting strategies are like laying a strong foundation. These tools allow you to pass on your wealth efficiently while reducing taxable value. Ultimately, a well-crafted estate plan does much more than just save money on taxes. It effectively acts as a secure vault for your life's work, ensuring your assets are protected and distributed exactly according to your wishes, providing lasting financial security for the next generation. In summary, while estate taxes target the total value of assets before distribution, inheritance taxes are paid by the individual receiving them. The best way to navigate both is through early, proactive planning to secure your family's financial future. Thank you for watching. If you found this helpful, please like, subscribe, and drop a comment below. For more resources, visit funerals.com to start planning today.